Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Have you ever had the thought, I really am not saving enough for the future? And at the same time, you're sitting down to write an enormous check to the IRS every single year for $100,000, $250,000, $500,000 in taxes? Guess what? We just found the money that you should be saving, and it's been under your nose the entire time. Go to freetaxwebinar.wealthwithoutwallstreet.com and learn how the wealthy are paying less in taxes. You can implement these strategies so that the next check you write will be to your financial future and not to the IRS. Welcome. This is the Wealth Without Wall Street podcast. Your host, Joey, the Italian Stallion Murray, along with Russ, the Idea Guy Morgan. And Russ is actually wearing an apron right now.
I am not. What are you talking about?
You got flour on your face. You're in a bakery right now. Did you not realize that?
I'm not in a bakery. A lot of times I have egg on my face, but what are you talking about, Stallion?
Okay. One, we are talking about cake. Having cake and eating it too. Who doesn't want that?
I want it. I mean, I don't want it in the month of October since I'm trying to go no sugar. By the way, just FYI, PSA moment here. I am not smoothie free, Starbucks free, sugar free.
I thought you had done it. I thought you were on the wagon.
I'm on the wagon, but there's been a few moments of, where I fell off. I relapsed.
Man. I'm sorry to hear that, but you know what? I have failed you way more than that. In fact, this weekend, I'm going to fail you again because it's my birthday. And this cake that we're baking right now on this podcast, I'm going to have, and I'm going to eat it too. Okay?
I have no doubt on that.
So what are we talking about? We're having cake and eating it too. We're talking about one of the 5 pillars of Wealth Without Wall Street today, right? Cash flow, life insurance, real estate, lending, and finally businesses.
But we're not talking about all 5 today. We're really talking about, I guess we will kind of break into 2, which is cash flow and the life insurance piece. The life insurance piece is the one, though, that we spend a lot of time on, but we get the most questions on as well. Like,
That's right.
How do you use these things as efficiently as you do to create passive income? How are you using it to buy the real estate? How are you using it to invest in your business? And so we're going to break out a few of those pieces today because I think it's important. And here's the thing. Just recently, my wife's on dental practice, and she'd been in a partnership for a long time. And the partner and her decided that it'd be best if we bought out the other half, and the other partner wanted to be able to stay home with their kids more. And so we bought out the 50% share, and we hired a dentist to come in full time. So now my wife, who has been for 10 years in this dental practice, basically hands on the wheel, right? Been in the driver's seat.
Sure.
Now, for all intents and purposes, has have to move into the passenger seat. And she's having to watch this other dentist work. And it's been a little bit rocky for the first 45 days just because she's just not used to not being the one driving, doing a lot of the things and having to watch, by the way, every time I get in the car with you, I'm constantly criticizing your driving.
Yeah.
Yeah. Well, that happens, right? We all know that. Nobody drives as good as we do, right? I would have done that. I would have taken that shortcut. I wouldn't have done that way. Well, that's kind of what's happening in our business a little bit. And through this transition, which we anticipated, there's been a little bit of drop off in patient flow. So income's a little low. So here I am. My wife's asking me, hey, by the way, bank account's getting low here at the office. Ooh, how much money do we have in those insurance policies that we own for the business purposes? And it's like, aha.
That makes sense.
Yes. We started policies for multiple reasons. One, for her to be able to save for equipment purchases. another policy we bought on an employee as an employee incentive plan. And now we're looking, okay, here's where these cash flows, these cash values that exist that were really more kind of longer term monies or, hey, reserve monies can be used to fill in the gaps of this short term need that exists. And I think that that's a huge thing, that when I have those kind of aha moments in my life, I think, man, how many people are compartmentalizing their money, putting it in places and only getting one job for $1? And that's not something that is a good thing, because we want our employees to do more than one job. We want our money to do more than one job. But a lot of times we do the opposite. We literally put our monies in boxes and say it can only do this one job and no other jobs.
That is such an awesome story, but it reminds me that Willie Wall Street is in our minds at all time. That Wall Street mindset has taught us that we have to separate money, that's to our benefit. Well, how is it to our benefit to have $1 doing one job when we know from understanding overfunded whole life insurance is the best tool to do two things at once? Just like you said, it's creating an incentive plan for a long-term employee we want to keep, a loyalty plan, if you will, and it's also there to fill in the gaps, because you're going to take some money, borrow some money from that policy, and are you going to have the next 8.5 years to replenish that money so it's there for the incentive?
Yeah, well, you said 8.5 years because you know that we have a 10-year plan. We're a year and a half in, right?
Insider knowledge,
insider information. But yes, it's like if you have an 8-year-old and they're not going to college until age 18, you have a 10-year plan. Well, of course, we do need to be preparing for that college education, but there's going to be some times that maybe we could use those dollars to do other things with, and not as I need to go buy a new boat. Oh, yeah. Betsy's got some money in her plan. Betsy would love to ride in that boat, right?
That's right.
That's not what we're talking about. We're talking about being smart. Again, we got to beat human behavior. We have to not spend every dollar that we make. All of those things are there's good reasons why we create limits on ourselves. But I'm assuming that if you're listening to this podcast, you're already working toward that. Now, I'm not saying that you've conquered that, and you're going to have some backsliding moments like I did by going to, Starbucks and getting my $6 milkshake, Frappuccino. It is that we're going to have those slip ups, but we're slowly being perfected.
That's right.
As we're working on it.
Now, so I'm going to veer off just for a second. When you say we've talked about compartmentalizing our money in these different types of accounts, well, some people have asked us the question, well, why do you have so many life insurance policies? Right? So, Russ, you have 15. Is that right?
I have 15.
One of those happens to be on me. So,
hold
on to that one. Okay.
I don't want that one to be cashed anytime soon.
But why would you have so many policies?
Cash flow. I want a place to put all my money. And, when I was a little kid, I used to save pennies. I don't know why I save pennies. I probably told this story a couple of times on this podcast before, but if you've never heard it, my dad saved pennies, and he told me one time that he was saving it because all those dollars he was be able to use to have him cremated or something. It was weird. But again, we literally are little mirror images of our parents to some degree. I watched him, so I started saving pennies, and so I had these little jars that I would save pennies in. And anytime I saw a penny, whether on the ground or in my mom's purse, on the counter somewhere, I would get it.
It's
right?
all of a sudden your money.
Exactly. Which that all our kids are the same way. My kids are like, "Hey, Dad, what do I do with all my money?" I'm like, "By the way, how'd you get money again?" Oh, I recognize that $20 bill. But I did that. I saved money into these little jars, and if you looked on the top shelf of my closet when I was in school, I had all these different jars of pennies. Well, why did I have multiple jars?
Because you found those pennies at different times.
Well, yeah, but at one point, one jar got full.
That's right.
When it got full, what did I have to do?
Got to find a new place to stuff that penny.
Yeah, either I was going to spend the penny or I was going to have to find a place to save it. And that's what's happened, since I started doing this in 2009. Clearly, I have more pennies to save. I started out with one jar, and when it got full, I moved to the second jar and so forth and so on. And I've found uses for dollars that I used to not be able to send through my life insurance policies because one, I was not efficient at that point in time. I didn't even know that I could do these sort of things that you and I are doing now. But three, I've got a lot more of them. And so I do have lots of insurance policies, and they, in theory, are doing different functions. But at the end of the day,
it's one big pool.
It's one big pool of cash.
That's
and
right.
I want to have access to all my cash, and I want my dollars to constantly be at work, and I want to be able to use them to do other things too.
Well, and I'm going to jump in, and my just quick little story about multiple policies is I feel like people, me included, and this is my story, I could only see so much when we first started this journey of understanding infinite banking. I could see one use when you shared this with me, and I said, oh, well, this makes sense. I had something I was already spending $2,000 a month saving towards. I said, well, let's just redirect that money. That was all I could see at the moment. And then what happened? In the first year, I ended up coming back to you and saying, hey, Russ, well, can I also save this over here through a policy? And you're like, yeah, you could do that. And I said, okay, well, what about this over here? Yeah, you could do that too. So I had 3 policies in the first year. And you, I don't know if you remember me asking this. I'm like, why the heck didn't you tell me that I could do this all at the same time? Like, I've been saving this money. You probably saw it. And what was your answer?
Well, you got to crawl before you can walk, before you can run. And this is not something that truly can be taught. It does need to be caught. And you were catching
experienced, yeah.
You started seeing it, and it is a funny thing that Nelson Nash, an author of the Becoming Your Own Banker book, we reference a lot of times on here. He used to do in his workshops where he would take a penny, and he'd say, outline the penny on your piece of paper, right? And so now you have this little small circle, and he would say every part of that circle is touching the piece of paper. And just assume like the penny is the knowledge that you possess, and everything that it's touching is knowledge that you don't possess. It's things that you don't know. Now take a cup and put it over top of it and outline the cup on it. So now you have a much bigger circle. What happened to how much information now that you had got bigger, but what happened to how much knowledge and information that you didn't have? It got much bigger too, right? Because now that circumference is touching a much larger piece of that piece of paper.
Gotcha. Yeah.
And that's what's happening as we see things, like you said, you see things with this small focus at first, and then it starts expanding. And that's what this podcast is about. We're teaching you right now every single step of the way. And a lot of you are coming to this for the first time, and we're getting phone calls from you all over the country. And you're like, hey, by the way, I want to start a policy on me, policy on my wife, and I want to put in this amount of money. I want to do this with my business. And you're coming with these ideas because you're educating yourself. We didn't have these podcasts when we first started. We didn't have all this education. We literally were bootstrapping it and learning as we went.
Right.
So I'm blessed that you get to have this information, but we want our money to be more efficient. And I'm sick and tired of seeing people with hundreds of thousands of dollars sitting in checking accounts because they really didn't know that there was a more efficient way to do things.
Well, that's what's really, if you think about it, cash that's sitting idle, no matter where it's located, if it's in your business, if it's in your personal, if it's, fill in the blank. Cash sitting idle is a huge burden. It's keeping you from the end. The end is that passive income.
There's a huge opportunity cost. And I realize some of you are in businesses where you have big ebbs and flows of cash flow, and you're like, I've got to keep. I mean, we know a guy that keeps over $1 million, and he calls it his Armageddon fund, right?
That's right.
And it's because his business can have huge ups and downs. Can you imagine the opportunity cost of what that money would be worth if it could have just be earning a couple, 2, 3, 4, 5%?
Oh, it's unbelievable.
And that's where it's like, okay, it doesn't matter if your Armageddon fund's 10,000 or it's $1 million like his. It's how do we get that money into an account that can be earning a much greater return, safer, by the way, because your checking account is not a safe place for it for many, many reasons. It's not safe. It's not safe from creditors, and it's not safe from the banks going under and you being able to not have to support them under this new Dodd-Frank Act. Go read that one and realize there is no more bailout. That FDIC thing that you used to use as the comfort, the security blanket. That's no longer what you think it is. But the fact is, we've got to have these dollars doing other things, because there's going to come a time when we want to get to retirement where we want to create an income, and we've given up all of that potential because we had money sitting idle at some point.
Yeah. And here's the deal. What quickly happens, and it happened to me, just like I explained, we go from this idea of why do you have so many policies to how can I start more policies? How can I get more of my dollars doing multiple jobs? Because you start seeing, man, instead of this vacation, I'm just going to give an example of an expense. Instead of this vacation costing me $10,000 to take my kids to Disney or to Hawaii or fill in the blank, I think 50 years from now, that's $100,000 expense because the opportunity it could have earned. Well, once you start realizing that, you start opening your eyes to this thing could have been growing the whole time. You're like, I got to get money in here as fast as I can. Who else can I get policies on?
Yeah. Where am I missing opportunities, right?
Yeah.
That's the question most ask of us, is where am I missing opportunities? I love these 5 pillars. I want to maximize every single dollar I get. I want to be actually getting that compounding interest, right? Because there's 2 edges of that coin. Either you're earning compounding interest or you're paying it.
That's right.
Right. So we want to be in a position of earning it. We want our dollars at work. We don't want to be dealing with this roller coaster stock market that we're seeing right now in 2008. People, it is so crazy. I literally just got back from Disney, and I'm telling you, the Yeti ride is nothing compared to what I'm seeing in the market. Up 400, down 600, up 150, down 450. It's a
joke.
That's a nut. I mean, we talk about how inefficient things are in many ways. March Madness is one of the most ineffective weeks in work. I mean,
absolutely.
They always talk about it because at the end of the day, somebody's sitting there watching, they're watching one of those games and they're acting like they're working, and then you come over and they flip the screen because everybody's got the little CVS app and they're going. There's probably 10% of the week is actually effective toward work. The rest of it is distraction. And it doesn't even matter if you're a basketball fan. People watch it anyway because they want to see, what was the Cinderella story this week? Well, that's what's happening with our money. Our money is constantly sitting in these checking accounts. Let's say we're a real estate investor. We take the money, we go buy a piece of property, it starts creating rental income. What do?
Put it right back into dead zone.
We put it back in front of the TV watching CBS. I mean, that's what's happening. I mean, it is constant. That's what's happening. What about the money that we have sitting for our retained earnings to protect against, the
downturns,
the slow month, like my wife's dental practice.
Yeah,
sitting there watching, the round of 64 game.
Yeah, it's dead. It's dead zone.
It
for
is.
Sure.
We need to be more efficient with our dollars, and that's why we have more policies. So, Joey, who can you own policies on?
Okay, so you have to have an insurable interest. Obviously, you have an insurable interest on yourself, so you can maximize the policies on yourself. So that's kind of where you and I have started, right? I think at the moment, I think I have over $6 million just on me. Well, at some point, the life insurance company says, "Hey, Joey, by the way, we know you're very valuable to society, but we have a limit on what we're going to put your life at." And so they tell you that it's based on your health, based on your income, based on your assets. And so then, and only then, and we talk about this is a question we get all the time. Well, should I go ahead and do one on my kid? Because my kid I have an insurable interest on too. And what would you say to that?
Well, a lot of times that question comes up, should I buy a policy on my kid? Because clearly they're much younger and potentially more healthy than I am. So it's got to be a better place for my money. So the answer is probably not.
That's right.
Here's the key is that first, the breadwinners of the family need to be insured because all plans end if they can't go to work. And if the reason you can't go to work is because you're dead, and it's great that you have policies on your kid and on your workers and all these other people, but who's going to pay the premiums on those things because you're no longer around?
Yeah, got to take care of home base.
You got to have enough coverage on yourself. So it is important to make sure we start there. But also the fact is that the way that we buy policies for ourselves and with our clients is that we're buying it with the smallest death benefit. So you may be 60 years old and I got a kid that's 6. We take $10,000. Of course, the 6-year-old is going to get a lot more death benefit for the same 10 grand. But did you know that the cash value is actually going to be roughly the same? I'm going to produce $600 to $6,500 immediately in cash value for the 6-year-old or the 60-year-old.
Yeah, that's crazy.
Well, it's just because the 60-year-old is that much closer to mortality. So my death benefit is going to be significantly less. And so they're going to be growing toward that amount quicker instead of the 6-year-old has a long time. But here's the key is that the idea is the 6-year-old can only maybe get 5 or 10 grand in a policy. Well, what are we trying to do? If I'm trying to use this to buy real estate, I'm trying to use this to support my business. I mean, what's $6,500 at the end of the day really going to do? I mean, it just isn't enough money. I got to get 60 grand in this thing. I've got to get 160 grand in this thing in order to do it. Well, I can't do that on a kid because it's going to buy like $1 bazillion in insurance, right? I need that 60-year-old who I can put $100,000 on and I can get like $600,000, $700,000 of coverage because that's a reasonable amount for a 60-year-old.
That's right.
But I want the cash. That's what I'm most interested in.
Yeah. So we also then say, okay, take care of home base. Talk about your spouse. Your spouse is definitely an important place to expand your system to, right? The right time. And here's the thing, that also aids into the passive income time frame that we're talking about down the road. When you start taking loans from these policies to create income, you're going to want to have you and your spouse to be insured if at all possible, because that's how you're going to be able to sustain that passive income if one of you were to pass before the other.
Yeah, we've talked about that and how, life insurance policies create passive income, and we went into the fact that, you want to have, again, we always preparing for windfalls. And if one of those windfalls is going to be, it's unlikely both of you guys are going to die at the same time. Typically the husband's going to die before the spouse. Women just outlive us. But we want to have a policy on our spouse, especially if they're not the breadwinner. If they are the breadwinner, absolutely, they've got to have all the money on them and less on us. But when we're taking income streams out, we want to be taking loans against those policies. So that way there's money when we have a death benefit come from one of the spouses dying. Now we funnel that big, huge lump sum in there. We don't have to go, what do I do with this money now? It's already got a plan for it. It's already got a place. And now we just double up on the income coming out of the policy on one person. So that's a huge reason to have policies on both people, not only to protect their human life value, but also for passive income time. But then there's also policies like we just talked about. We have policies on each other. Look, Joey, I love Jessica. Okay, let me take 2 steps back here. I don't want to be crossing any boundaries.
Whoa.
I love her like a sister, right? I mean, she's done wonderful things in our office. I love the fact that how you guys are raising your kids. But I don't want to be in business with Jessica. So if you pass, I bought an insurance policy with an agreement on your life that I own that says, okay, this amount of money comes into me, and I write a check to your wife because we have a predetermined agreement of value of what our business is worth. I write her a check because she wants cash. She's going to need cash to replace the stallion. And I'm going to help her. I'm going to do all those other things, but we're not going to want to be in business together. And that's the biggest reason why you buy insurance on business partners. And if you own a business and you have a business partner, whether that's a real estate business or that's a truly brick and mortar business or digital business or whatever, you need to be taking care of this because it's a huge thing.
That's right. Yeah. And that's obviously we're talking about a buy-sell agreement. And if you don't have that in place, obviously take care of that and fund it however you possibly can. But the whole life doing it on each other is just critical. It's a great step, even if it's not initial down the road.
Well, this is an example, though, of what we're talking about from the beginning, having your cake and eating it too, meaning that we needed to buy insurance on each other to to govern that factor. But at the same time, what are we doing? We're putting dollars that we want to make investments in our business. So we're holding those right now in reserve within the cash values of these policies. And then we're making investments and taking loans against those to invest in our business. And then obviously the profits that come, we just funnel it back. So now we have a dollar doing two things. It's protecting the death benefit that came along with that, protected our valuation. But really, the cash is what's allowing us to reinvest in our business, which we want in order to grow.
Okay. Listen, Russ, we have talked about a ton of like practical application, but let's really talk about how to identify what steps need to be taken right now. You're sitting here, you're hearing this, you're saying, okay, I got some dollars that are deadbeats. Okay. These things are not pulling their weight. They are doing one job and one job only, and it's not even that good. They're stuck in March Madness. How do we figure this thing out?
Well, you got to do a roll call.
Roll call.
You got a little, hey, Ron, D nice. Well, yes, we need to really seriously get our monies that are going out the door. We need to know where they're going. And I love using tools that like these financial aggregators. I used to use mint.com. It was kind of that free tool that I could use. It wasn't perfect. And I always got these ads like, do a new mortgage or, some financial person trying to sell me a, Roth IRA or whatever. So that's why we bought the tool that we now use, and we affectionately call it the virtual safe, because it allows us to put all our insurance policies in there, which that's what Mint.com couldn't do. And it allows us to put anything, our real estate ventures, our business ventures, all these different things. And now all the 15 logins we have, we can go one login and it puts it all in one place. And so we give that to our clients because we know what a benefit it is to have all your assets under one roof where you can see them. Obviously, clearly they're not under one roof, but you can see them, which is the biggest problem that most people have, is that literally we got, in my household, I got 4 kids. And if one of them goes missing, and you know what I'm talking about, Ryan, my 5-year-old, soon to be 6, if he goes missing for a long period of time, like 6 minutes or longer, I'm wondering what thing is being destroyed.
Yeah, exactly.
Right? I need to keep my eyes on them. Well, our money's that way too. I mean, how many times have you met somebody, Joey, and you're going through their stuff and you're asking them questions where their money are, and they're like, no, that's it. And then you go, what about this kind of account? You have this.
Oh, yeah. You know what? I do have one of those. Yep. Forgot about it.
It's the forgotten kid. And like Ryan, it's probably not up to good. It's up to no good.
So you got to take an assessment, right? Figure out where the money is. What money is just sitting there doing nothing? Personal savings, your business retained earnings, college savings accounts. Guess what? We don't have time to get in it today, but we're going to have an infinite banking and college savings talk here come real soon. So stay tuned for that. Your college savings is great, but is that the only job it's doing? It shouldn't be.
Yeah, seriously, I hope my kids know that if they get a scholarship, instead of having this, 529 plan with some crappy mutual funds in it, that most likely if they're roller coastering right now is not that good, and they're going to have all these penalties because, hey, by the way, you did such a good job. There's a penalty for you to get the money out since you're not going to use it for education. Instead, oh, by the way, it's a rental property that you're going to get an income stream on for the rest of your life, or as long as you hold the asset before you sell it. What a beautiful thing. It could have been used to pay for the bills, but since you did a good job, it can help you create income.
Yeah. Don't steal the thunder on this, okay?
Okay. So really what we're trying to say is if you got an asset, we're going to do roll call, put one of those things in a headlock that's not doing at least 2 jobs or more.
Fire them. That employee needs to be fired. All right. So number 2, you got to set up accounts that allow it to do multiple jobs. What are we talking about? Life insurance. We're talking about high cash value life insurance in mutual companies that pay a dividend.
Yeah, properly structured, dividend paying. And we say whole life insurance. Don't let somebody fool you into believing that because I can track an index, Willie Wall Street, and you should be using these index universal life because they're so much better. The problem is that when they are like this year, by the way, we're at zero return for this year. Right, we've had all this great returns, market highs, but after all of this fall off of the last couple of weeks, we're at a zero return for this year. So you know what would happen if you had one of those great fancy index universal life policies? They say they have a floor, meaning that they will always gain 2%, but yet they don't tell you the expenses to run that thing's about 8%. So your account value is going to go down. That's losing money. The objective should be to earn and grow. That's compounding.
We want earning.
We want the and asset.
That's right. All right. So number 3, after you set these things up, you've identified where the dollars are just laying down on the job. You set up the accounts. Now you're watching how fast you're going to get to your goals with this money doing more jobs.
Yeah.
Okay. What does that look like, Russ?
It looks like me knowing that when I was on all those vacations that you were giving me crap about a second ago, I know how you were using my vacations as these, exorbitant expenses.
Well, we all can't go to Hawaii, Russ. I mean, come on.
Hey, I don't know. There was plenty of room on the plane I was on. You could have come. But yes, it is seeing that the fact that we can be traveling, we can be investing in different things, we can be, reinvesting in our business and having our money at work. And that's the key here is, I know we keep harping on this. It is having your cake and eating it too. I want to simplify my life. I mean, we sat here with an 87-year-old man, Nelson Nash,
the founder of Infinite Banking.
He laid out for us the plan that he has for his wife. He's preparing her, as he says, to be a widow, and he's sharing with us what's going to happen. And it was so stinking simple.
I mean, can y'all imagine for a minute this one place that you have to park money that you then use throughout life to finance all of the things that we have to do. I mean, and there's a freaking long list of things we have to do with money. And then to look up, and now, as we saw in Nelson's spreadsheet, just a simple spreadsheet, he simplified life by putting it all through there. His wife is going to continue to have a solid income and to have a windfall of tax-free dollars that are far surpassing most of the people you know as quote unquote wealthy that have been paying down assets in retirement. In fact, I just experienced this even in my own family. My wife's family had a recent passing, and everybody would have said, oh, this was a wealthy family. And to be honest with you, I don't think there's anything left. And it was way more complex than what Nelson's talking about. He's been able to give hundreds of thousands of dollars, if not millions, away in other policies that he was gifting away. And he's still got, I mean, I'm not going to go into specifics, but a very substantial sum of tax-free income that his wife is going to be able to have.
Is receiving now and will receive at his passing. And that's the beauty of this is we want to simplify life, right? I mean, so
peace of mind.
I think, we've talked about this, that we give our clients this tool called the virtual safe. And it is literally, let's get all of these crazy things, let's put it under one roof. Let's be able to see it under one key login. But at the end of the day, when we are figuring out what it's going to look like when we're not here, it needs to be simple. It needs to not induce stress, which, by the way, that makes life shorter is when we increase stress, right?
Doubt.
So if the objective is, I'm going to run out of money fast, I probably should invest in things that are going to create stress in my life, because then I can just shorten how long I'm going to be here. But if we're literally trying to figure out ways to enjoy our life, to experience the things with our kids and our grandkids, we want to simplify that process. And I love the fact that he shared all those things, because he didn't need, even though he has a very substantial estate, he didn't need to pay, tens of thousands of dollars to estate planners because he had simplified it. He created strategies to already gift it away in a way that actually avoids some of the gift tax rules. And when his wife gets it, she's not going to worry, do I have enough?
Yeah, it's an unbelievable feeling. He's told us multiple times, you have no idea what it feels like to not have to touch a bank in 22 years plus and counting. And then in this case, to not worry about how you're going to leave your wife. So all that being said, we're getting our cake. We're eating it too. We're going to do as many policies as we can do. Hopefully today you learned some of the ways that we're implementing that, and we wish you the best. Thank you for tuning in today.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.